Hi, friends, and thanks so much for being here. No matter what the world looks like around us for now, an incredibly prosperous time is ahead for our industries. And in the next few minutes, I'm going to show you the proof. We'll look at the historical patterns in a few different major economic categories and compare them to where we are today, and then show you what that means for the real estate and mortgage business right here at home. So we're going to talk about interest rates, real estate, and recession. There's lots to talk about. First up, inflation is a big buzzword. We've got inflation over 8% now, as of this recording, as measured by the Consumer Price Index. Inflation is the arch enemy of mortgage rates because a receiver of those mortgage payments typically receives a fixed payment from a homeowner over a long period of time, and inflation makes things cost more, so that payment that they receive buys less and less. So if you're the receiver of mortgage payments, the only way you can combat higher inflation is to have a higher interest rate to offset the more rapid rate of erosion of the dollar, the currency. Of course, the greater driver of rates is the mortgage-backed securities, mortgage bonds market, but that's for another video. Well, now there's a lot of talk about the Fed, too, and we're going to get into the detail on all of these. This is just a quick rundown of what's coming up. We've seen the Fed hike their interest rates quite a bit this year, and this is known as the Fed funds rate in some circles. But counterintuitively, hiking their interest rates is not necessarily a bad thing for mortgage rates, because when the Fed hikes rates to slow economic activity and a slowdown in inflation actually results, mortgage rates respond favorably and they decline, and I'll show you the history of that. Now, the other big buzzword is recession, and I'll show you in just a moment the historical numbers that show we will be in a recession soon, if we're not already by the time you see this video. So what does that mean for mortgage rates, and what does it mean for housing? Let's get into it all. Let's take a quick look here. First, let's take a look at the Fed and do a quick recap of recent history. If we go all the way back to the 70s and 80s, starting the late 70s here, Arthur Burns was the Fed chair. He watched inflation go from 7 to 14%. As a result, and remember, in past videos, I've told you that mortgage rates have to go up when inflation goes up, and it did. They went from 12% to 18%. So Paul Volcker came in. He took our Fed funds rate already at 11 to 20% within 2 years. And it slowed the economy enough so that inflation went way, way down. And because inflation dropped, mortgage rates went down. So let's understand this part. Fed funds rate way up, and because inflation declined to a slower economy, mortgage rates dropped. So Fed funds rate up, mortgage rates dropped. But there was a recession. Just about every time the Fed tries to slow inflation in the economy by hiking rates, we get a recession. And the stock market, as you can see, didn't like that at all. Under Greenspan, he also saw inflation rise, and as a result, mortgage rates rose. He took the Fed funds rate up almost 2% within a year and slowed the economy enough to where inflation dropped, and because inflation dropped, mortgage rates dropped from 8.5 to 3.5. That's a big drop. So think about that. The Fed hiked rates, and because it slowed the economy enough to reduce inflation, mortgage rates declined. So you can see the pattern here. But again, part of that pattern is recession. It's almost unavoidable. And, of course, bad stock market performance. Now, our guy today, Jerome Powell, has seen inflation go from 1.5 to 8.5%. as of this recording. Now, by the way, if we're comparing apples to apples, if we go back and use the late 70s and early 80s methodology for factoring inflation, our inflation today would be at about 16 to 18% easily. But that's just a side note. So mortgage rates go from 2.5% to above 7% as of this recording. The Fed funds rate is now at 4%. We just saw them hike it just before this recording. And we'll likely see it go higher before the end of the year, 2022. And hopefully that will be the step that causes inflation to drop. And the consistent historical patterns tell us that mortgage rates would then drop as well. Now, it does look like a recession is pretty much unavoidable now. And you know the stock market, if you go by history, might be a difficult time for the stock market. Well, let's take a look at the last time we'd been in this situation where the Fed was hiking rates, but had a balance sheet that they started to allow to run off. Now, the Fed's amassed like $9 trillion They bought up a lot of mortgage bonds and treasuries when COVID it was just in its early stages. And they've been saying they're now going to start to allow runoff as they mature, as they collect principal payments. So what that means is instead of reinvesting this money that they're bringing in off the mortgage bonds and treasuries they've purchased, they're going to allow a portion of those, and maybe all of them, as they come in, to just run off their balance sheet and reduce their holdings. Now, that means they would be purchasing less of the mortgage-backed securities. So it all started at the end of 2015, December 2015. The Fed hiked by about a quarter. And what happened here? Mortgage rates actually dropped. And then as inflation started to creep back in, mortgage rates went back up. But when the Fed hiked again, mortgage rates dropped. The Fed hiked here, and mortgage rates dropped. The Fed hiked here, and after a bump up, mortgage rates actually wound up getting lower than where they were when the Fed hiked the rates. But then there was talk about a runoff of the Fed's balance sheet, similar to what we see today. And just on the talk of it, rates started moving up. And when they actually started the balance sheet runoff, rates started really to rise. And as that runoff continued, even though the Fed hiked right here, the runoff overwhelmed it, and we started to see mortgage rates rise. Until the Fed rate hike, we see a bit of a dip here, but that runoff continued to pressure mortgage rates a little higher. But then the hikes eventually started to take hold. So here now you've had 1, 2, 3, 4, 5, 6, 7 rate. It was the 8th rate hike. So the Fed hiked rates by about 2%. And finally, mortgage rates started to respond as the economy slowed and really started to move down here and then cascaded lower. And then when the Fed slowed their runoff because the economy was really slowing, you saw a big drop. And then when they stopped the runoff of the balance sheet, well, you see a huge decline. So it's very constructive to learn from this because we can see that mortgage rates, while they're high now, there's a bright future right ahead of us, even though the Fed is going to be hiking it once we get past the period of the Fed runoff. So there's great promise here. Now, there's another sign of mortgage rates coming down I want to get into. You've been hearing a lot about inverting and inversions in the yield curve. An inverted yield curve shows that interest rates on long-term investments are less than those of short-term investments. A lot of times what that means for us in our industry is the 10-year Treasury is yielding a lower rate than the 2-year Treasury. And that's not normal because the longer you tie up your money, the bigger the risk, and you should get a greater reward. And when this happens, it's a great indicator of recessions. In fact, a negative 10-2 spread has predicted every recession from 1955 to 2018. Now, in 2022, we saw a brief inversion in April, and then it went underwater in late July and has stayed there to this day, as of this recording anyway. So history tells us that a recession is coming. And as you can see, it's been pretty reliable through history in the 70s. You can see the shaded areas here are the recessions. Through the 70s and the 80s, the 90s. Every time you get that inversion, a recession follows. And once again, the 2000s, late 2000s, 2019, and then the 2020 recession in the early days of COVID. This is that small inversion in April. So like Mark Twain said, while history may not exactly repeat itself, it does tend to rhyme. So what's that mean for us in real estate and mortgage if we have a recession? Well, we'll get into that in just a moment. There are one more indicator here I want to watch out for, a very reliable one, and that is the unemployment rate. When the unemployment rate reaches its lowest level and then starts to rise, it becomes a great indicator that we're going to have a recession. As you can see, going back to the 40s, the lowest level starts to rise and a recession. It hits the lowest level, starts to rise, recession. Again, every time with 100% accuracy. Here's the most recent one, where we are today. Could we go a little lower here in the unemployment rate? Have we started to move up in the unemployment rate? Well, not yet, but perhaps soon, maybe by the time you see this video. As the Fed hikes start to take hold and we start to see things slow down a bit, that employment rate starts to tick up, as you can see, and it is a very reliable forecaster of recessions. So what does that mean for us in mortgage and real estate if we have a recession? Is it a bad thing if we get one, like we're thinking we're going to see maybe by the end of this year, first of early next year? As far as mortgage rates are concerned, we've seen drops in mortgage rates every single recession, and by quite a bit, I might add. So recessions have to be bad for real estate then, right? Not exactly. As we look at real estate, you can see that in the 60s, the 70s, the 80s, 90s, every time we've had a recession, prices actually did well and went up quite a bit afterward, even in the early 2000s. Now, the one anomaly here was the housing bubble. I mean, come on, when you have zero down loans and you can qualify by having your pulse checked, I mean, no income, no asset, no job, poor credit scores, and you're still getting a mortgage? Well, the housing bubble was inevitable. And that actually led us into the recession. It wasn't the recession that caused home prices to decline. So after finding our footing, though, you can see prices have gone up quite a bit since then. And actually, the last recession was true to form of the previous ones, other than this anomaly in the bubble. So 8 of the 9 recessions saw home values going up and continuing higher. Now, the housing market today is clearly a lot stronger because if you look here in 2007, there was a lot of inventory. There were 3.7 million units for sale. Today, there's less than 750,000 units available for sale. There's actually, in the latest report, more than 1 million showing for 1.2 million, I think, but many of those were already under contract. So the actual units for sale is less than 750,000. So that's a lot less inventory than back in 2007. But meanwhile, households since then have grown. You can see the number of households is much, much greater than it was in 2007. So you get 14 million more households fighting for 3 million fewer homes. So while we have a period of time here to contend with, and it's going to get rough, but the future looks very, very bright. Now, that said, we are in a time of unprecedented change. There will be events occurring like we've never seen before. I don't mean just in our industry, I mean in our nation, in our world. By the time you see this video, it may seem like our world has just been turned upside down. But remember this, and again, coming back home to our industries, mortgage and real estate, as we've seen, downtimes are followed by prosperity. As you've seen throughout history here that I've shown you, downtimes are followed by prosperity every time. Following unprecedented times comes unprecedented prosperity. What I'm saying is on the other side of this, what's upon us right now, we, the survivors, will experience a time of greater opportunity and prosperity than we've ever imagined. It is coming. It's coming soon, so hang in there. Don't give up. And on the other side of all this, we are going to share in an absolutely wonderful time, unprecedented in our industries. Thank you so much for being here. I appreciate you so much for all you do. I'm Rob Johnson, and I'll see you later.